If you're a billionaire, most people would agree that you are too big to fail. Even if your assets plummeted 70%, you'd be left with hundreds of millions of dollars. If you were originally a multi-billionaire, you may even still have $1 billion left. While this is true for cash billionaires with little debt, not all billionaires' wealth is built upon such solid foundation. In many cases, a recession or downturn in the market is all that's needed to wipe them out, and no one knows this better than Chamath Palihapitiya. You've likely heard that Palihapitiya was an original member of the Facebook management team before founding the venture capital fund Social Capital. You've also probably heard that since 2011, he's been part of a group that owns the NBA team Golden State Warriors. Although wildly rich today, Chamath Palihapitiya was actually a refugee in childhood. But there's a lot more to his story, and in this video, we are going to talk about Chamath Palihapitiya's collapse. Is this the first of many financial failures of 2022? Watch this video until the end to find out. Also, if you enjoy finance content, consider subscribing or liking the video. I spent a lot of time researching these stories, and only a small percentage of my viewers are subscribed. It's free and you can always change your mind. Chamath Palihapitiya was the face of the SPAC craze that carried financial markets at the start of 2021, but today he is the face of a downfall. Chamath has taken 4 different companies public via SPAC so far: the private space tourism company Virgin Galactic, the real estate marketplace Opendoor, the health insurance company Clover Health, and finally the online personal finance company Sofi. All of them started at an initial price of $10. The best performing one has been Sofi, which now sits at $9.82. The worst performing one is Clover Health, which now sits at just $3.43 at the time of recording this video. Virgin Galactic stock initially did very well, and it was hyped by the retail investor because it was the very first public pure-play space tourism company. But delays to its planned space launches and the commercial tourism industry promised by founder Richard Branson have kept Virgin Galactic shares volatile. While Branson beat Jeff Bezos' Blue Origin into space, both companies have had to delay their space flights, and to this day, Virgin Galactic has never flown a single paying customer into space and is burning millions of dollars every single quarter. If you bought at the initial stock price of 10, you would have lost more than 20% on your investment by now. The next company on the list is Opendoor, which merged with Social Capital in June of 2020. It looked impressive at first, much like Virgin Galactic. It was worth $35 per share at its peak in February of 2021, which is more than 3 times its initial price of $10. So where did it all go wrong? Well, to understand that, we have to look at how Opendoor works. Opendoor is a company that grew popular because of the iBuyer technology trend. An iBuyer is a company that uses technology to make an offer on your home instantly. It theoretically makes it easier, faster, and sometimes cheaper to sell a home. The business model of Opendoor is based on selling the houses it buys up for a profit. The company also makes money through a sales fee, which is paid by the home seller, as well as interest on mortgage loans. So basically, Opendoor wanted to revolutionize the way of selling real estate. The problem is that saying it is far easier than doing it. Real estate brokers are familiar with the details and nuances of the communities in which they operate, the architectural styles of the houses, recent trends in the neighborhoods, and a whole host of other qualitative factors determine a home's value beyond just the number of bedrooms and bathrooms. Opendoor uses artificial intelligence algorithms to predict how much a home is worth. If their artificial intelligence is up to the mark, they should be able to give you a realistic offer. However, if their AI is bad, people with low-quality homes will be more likely to sell because Opendoor is a buyer who is willing to pay the average price for even the worst house in the neighborhood. On the surface, everything looks pretty good. However, if you look on Yelp, you'll see that Opendoor only has 3 out of 5 stars. Many customers complain that the company uses bait-and-switch tactics, in which they make a high offer for a home, but then deduct a ridiculous amount for repair costs. So you end up getting a worse deal than using a traditional real estate agent in a lot of cases. In 2021, Opendoor was able to more than triple its revenue from the previous year. Despite making lowball offers, they only managed to achieve a 9% profit margin, which is extremely narrow. In addition, Their success in 2021 can be credited in part to luck, as they hold a home on their balance sheet until they can sell it, so they are sitting on billions of dollars worth of real estate inventory any given time. They got lucky in 2021 when real estate prices skyrocketed. If another real estate crash happens, similar to the one in 2008, Opendoor may face bankruptcy as investors realize that the value proposition to customers is arguably worse than that of a traditional real estate agent, as well as the fact that they can carry a lot of risk on their balance sheet. Clover Health was Chamath's biggest blunder. It is a New Jersey-based health insurance company that helps in the administration of Medicare plans. It was launched in 2014, but has yet to grow significantly or generate consistent profits. This was expected to change with the introduction of a groundbreaking new product known as Clover Assistance. It's a piece of software that uses machine learning to predict a patient's health needs and make treatment recommendations to doctors. This saves money and improves health results. Everything looked good until a few months later when the short-selling firm Hindenburg Research published a stunning short report which revealed that Clover is under investigation by the Department of Justice. According to Hindenburg, the investigation focused on Clover's use of false marketing tactics and, more or less, a scheme to scam the government by collecting questionable Medicare claims. According to Hindenburg, the Clover Assistant, which was Clover stock's main driving factor, does not actually assist patients. It's simply a tool for businesses to use to report meaningless medical conditions to the government and then charge them greater Medicare bills. Clover has experienced rapid growth in recent years, more than tripling its revenue. But is it because their technology has improved, or is it because they got better at scamming Medicare? The stock began free-falling when the investigation was made public, and it eventually lost 70% of its value. It's a penny stock with the share price of $3. Chamath Palihapitiya is currently being sued by Clover investors who believe they were deceived because the active inquiry was never mentioned during the SPAC process. It's a huge mistake, and we can all learn from it. Honesty and a spotless image goes a long way. However, despite the fact that Clover SPAC was a complete failure, Chamath and his partners walked away with almost 20 million free shares of the company. Chamath and his partners invested $171 million in exchange for 17.1 million shares, but they also received 20.5 million shares for free. Clover's stock price has fallen so far that even with this tremendous advantage, he's still losing money. This shows how unfair SPACs are, because an individual investor must buy in at $10. Chamath buys in at $4.50, thus the stock must be more than halved before he loses any money. Now we'll take a look at his most recent SPAC, Sofi. Sofi climbed in the months following the merger, but eventually came crashing down. If you got in at the original price of $10, you would have lost roughly 1% of your investment. So it wasn't a major loser, but it also wasn't a big winner. Sofi is a one-stop financing app that allows you to apply for mortgages. You can consolidate your debts and invest in insurance. You can also keep track of your spending and invest in the stock market. The goal is to have an all-in-one shop for your personal finance needs. And because they don't have the overhead costs of brick and mortar branches, they can offer more competitive rates than traditional banks. They've had outstanding growth over the last 2 years, more than doubling their revenue. However, much of this growth can be linked to rising sales and marketing expenses, causing your net losses to worsen despite the increased income. They are simply using the money from Chamath's SPAC to keep burning cash and maintaining hyper-growth. But on the positive side, it looks like they do give a superior value proposition on the Apple App Store, where they have a 4.8 out of 5-star rating and over 100,000 reviews. This is a huge improvement over Opendoor's 3 stars. So despite the fact that they are burning cash, they certainly have a bright future ahead of them and will continue to take market share from traditional banks. Based on all the evidence, Sofi looks like the highest quality company. However, following the merger, Sofi has underperformed the SP 500 by a large margin. But to be fair to Chamath, he is an early-stage technology investor, and all 4 of the businesses he chose are currently losing money as the Federal Reserve prepares to raise interest rates. Investors have lost faith in these money-losing companies. This isn't Chamath's fault. He just happened to be in the wrong place at the wrong time. However, taking Clover Health public while they were under investigation by the Department of Justice and neglecting to disclose this to investors is definitely a massive mistake. Virgin Galactic's performance is also mainly the company's own fault. They consistently overpromise and underdeliver on when their first commercial spaceflight will take place, and you can't blame the government for these operational shortcomings. Given Chamath Palihapitiya's history, asking SPAC investors to support the next deal will be extremely difficult. Considering the number of stocks that have been launched in the last 2 years, most of the good companies have already gone public, so it's becoming very hard to find great deals. Chamath had no choice but to dumpster dive with Clover Health. It was rumored a few months ago that one of his last SPACs was in talks to merge with Equinox, a luxury gym company. Equinox is not a technology giant. It is simply a super luxury gym that caters to the rich people. But the deal didn't go forward. It's looking more and more likely that Chamath will not be able to find any targets for his last 2 SPACs. If this happens, he will be forced to sell the company and refund the funds to the shareholders. Last month, Palihapitiya resigned as Virgin Galactic's chairman. He was one of the most talked about people in the finance world in 2020 and 2021, particularly among individual investors, but his SPACs have been total failures. Only time will tell if he can rise again from this low point in his career as an investor. Is there a way Chamath Palihapitiya could have stopped these financial blunders? Let me know in the comments. And if you learned anything new from this, click the subscribe button and hit the bell icon to be the first to see our new videos. I make deep dives like this every week where I uncover the secrets of money and business.